So we're looking at, we have a list of tickers, and we gave it this list, right? You can actually see this list here. So this is our list of tickers: Hood, VST, STX, WDC, Palantir, App, NRG, CCJ, Carvana, and HIMS, right? So that's the list of symbols. So it looks through those lists of symbols and says which ones have performed the best over a 3-month period, and ranks those and then buys the top candidates, right? And then it will find, based on those top candidates, ones that are 3 weeks or 21 days to 60 days to expiry, right? So we're looking for those, and at the money, right? And then sizes each position to 15% of cash and allows up to 2 simultaneous underlyings. So each one of them will be 15% each and should own up to a maximum of 2, right? And then sizes each position to 15% of cash, allows 2 simultaneous. Okay, and then also applies a VIX gate. This is something that we added, I think, last week or the week before, where if you guys don't know what the VIX is, it's the volatility index. So this is what the VIX looks like, right? If you guys aren't trading using the VIX, where are you, right? This is probably one of the most useful things to look at when you're trading. So this is the VIX index, otherwise called the volatility index. Basically, what it does is it measures what's called the implied volatility on the stock market, right? So I believe this is done on the S&P 500 specifically, and it's looking at a bunch of expirations on stock options, and it's saying, based on those expirations, what is the implied volatility? And it's like doing this pretty fancy math. It's but it kind of just boils down to like, what is the implied volatility on those options? And implied volatility kind of just says, it's using, I guess we have to talk about a lot of stuff here. It's using the Black-Scholes model essentially to figure out, based on the price of the option, what are people thinking is going to happen to the stock market? Because this is a very interesting thing that happens in the options market. This is a little bit of history here, and if you guys don't know about this, actually pretty cool. So the reason why the VIX index works is because whenever people are expecting the stock market to go down, and these are usually sophisticated traders that are trading in options, the options traders tend to be, a little bit more highly educated than the rest of the market. Let's put it that way, because it is a more complex thing to be trading. So whenever they're expecting the stock market to go down, they tend to buy put options, right?